Welcome to Wattle's monthly update. I'm joined by Drew Meredith again to review the month of March. Welcome, Drew.
Thank you. Good to be here.
What a month.
I know you say it every month at the moment.
What a
don't
month.
You know? I can't remember what happened this month.
Well, there was a credit crisis, or maybe the risk of another credit crisis. We saw a bank collapse in the US and, one in Europe, which we haven't seen for a long time.
Yeah, they called it a 1920s bank run, like the Great Depression.
Yeah, let's talk about that. Let's talk about SVB, so Silicon Valley Bank, and over the month of March, it was declared bankrupt. And what happened there? And
then bailed out pretty quickly straight after. I think I was heading up to a wedding in the country,
sure,
and starting to get phone calls on Friday afternoon.
From me?
Yeah, from you and multiple people at the time.
Yep.
But essentially, old-fashioned bank run. So banks don't always have the amount of cash. Obviously they take money in and then lend some of that out and create credit that way.
Sure.
But essentially every one of their deposit holders, about $100 billion worth of deposit holders, wanted to withdraw their money at the same time. Yep. And they didn't have the cash or liquid assets to provide that at that point in time. So basically the government stepped in and said, you're insolvent and we'll take control of the bank.
Yeah, let's take one step back. So through the GFC, we learn a lot of things, right? So we learnt that depositors get scared when market is volatile and there's risk around, there's a lot of white noise. So governments right around the world guaranteed $250,000 will be secured by the government. In Australia, it's $250,000. In the US, $250,000. Obviously, in Australian dollars, that's $330,000. So that a bank run, a traditional old-fashioned bank run, shouldn't happen. No. So how did SVB? What happened there?
I think both it and the other one that went bankrupt was Signature Bank, and they were both idiosyncratic, or they're very specific banks with specific focuses. Yeah. Like they were very, very targeted on a certain asset class or certain sector. So Silicon Valley Bank, for those who are unaware, Silicon Valley is where all venture capital and technology firms have come from, or where they are at the moment. So things like Facebook when they were starting, but also a lot of the venture capital companies that have been growing quickly but lose a lot of money. Uber, for example, loses hundreds of $1 million a quarter. Essentially, Silicon Valley Bank became the banker of choice for all those venture capital firms,
sure, all
the tech firms, and a whole heap of loss-making companies. So over the last 12 months or 18 months, they've seen the big, I think, $150 billion in deposits start to go down quite quickly, which they were, in hindsight, they weren't actually investing more aggressively than any other bank with those proceeds. They're actually lending out less money than probably the Commonwealth Bank and other banks. They just got caught by a turn in sentiment and people wanting to get their money out at the same time.
And rumours sank the ship.
On Twitter, yeah.
That's right. So we're even more connected than we were in 10, 12 years ago in the GFC, a lot more connected than we were 30, 40 years ago when there's been some bank runs. So this time it went really quickly, where there was a massive demand to withdraw money from the bank, and that's when the stability started to unwind quite quickly.
And the other one that went down was called Signature Bank, which was actually the bank of choice for crypto investors or crypto platforms. Again. So it was kind of very specific to a certain sector that was having serious problems beforehand.
Yeah, you got to be careful about liquidity and what liquidity actually does. Yeah. Everyone wants liquidity, but there's also a negative about liquidity as well, right? So we'll explain that further in other podcasts that we do. But this concept that some assets are best held that are illiquid over a long period of time, and when you do provide liquidity, you provide choice, and then people, if they've got choice, will panic at certain points. It's no different to our investors,
any other
right?
Assets, So property and other assets at the moment. I think the most interesting thing was how quickly the central bank stepped in. Sure. So if you think during the GFC, it started in there were hints in 2007, but it really didn't hit the worst until late 2008 to 2009, before the central bank actually stepped in properly.
Yep.
And we were still increasing interest rates in 2007 as it started. In this case, the collapse happened on Friday, and the central bank had come in on Monday to guarantee deposits of all the people who had put money into the bank.
Sure.
Basically cut the risk of systemic issues and bank runs across the whole country in about 72 hours.
We've often argued that the top 5 banks in Australia essentially have got sovereign credit worthiness, because we know that the governments, Western governments around the world, won't let banks fail in the same format that they did. And we saw that in Europe as well, where Credit Suisse wasn't necessarily an issue in March. There's been rumours around it for a long time, probably 3 years, about the solvency of Credit Suisse. And sure, that business has been sold to UBS, but it's really funded by the Swiss government.
And forced as well.
$104 billion of loans to buy Credit Suisse. And that's a different story. That's not necessarily a run. That's probably a story of greed and, using their balance sheet to guarantee investments where their balance sheet wasn't as strong as they thought it was. So
again, it was a company that was struggling. Profit was going down. It was having all kinds of issues throughout the business, and this kind of turn in sentiment effectively forced change.
Yep. So the government support in the US, you could arguably say that that'll go around the world. So therefore, this credit crisis, or the start of a credit crisis, seems like it's been headed off at the junction.
Incredibly quickly, and that's why markets have kind of settled rather than falling 20 or 30% like they probably did during the GFC.
Yep.
And you have this. So what the central banks have done is given these banks access to credit or to cash really quickly to meet deposit holders or deposit requests, which in itself kind of stops the bank run.
Sure. Yeah.
Hopefully.
Sure.
But then we have this question, which we'll probably go through as well. The central bank's giving $150 billion in liquidity as a loan to all these banks while increasing interest rates into the broader economy, which is kind of counterintuitive.
Yeah.
To me. I think to most people.
For sure.
Yeah.
So let's talk about then other things that happened in the month of March. Probably not in the month of March, but in the month of March we saw interest rates in the US go up.
Yes.
But more importantly in Australia, they were put on hold yesterday.
Yesterday, yeah. Yep. So I think we both increased in March, 20.25%.
Yep.
In the US, which did it straight after the Silicon Valley Bank collapse, which everyone kind of found a bit strange. Then overnight, as we've been kind of talking about, and as I think markets, when you see, we can discuss the yield curve.
Yep.
The market was suggesting interest rates had peaked, and what you've seen is the RBA pausing to see what impact they've actually had on the economy.
So one of the biggest, for the people that are listening, one of the biggest inputs into our economic models is a thing called a yield curve, and really all the yield curve is tracking interest rates on a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 year basis, and then understanding what shape that is, and that shape historically has been a great indicator of what economies will do in the short term and the long term. And we can have a masterclass about shape, but when Drew talks about yield curve and seeing forward indications of what the economic environment might be, that all comes from, a lot of it comes from the yield curve.
And the concept is that the longer you're locking money up into a government bond or a term deposit, you should be paid more to do that.
Yep.
But what the yield curve was doing was paying you less for lending money or buying a term deposit for 10 years versus 2 years, which suggests that interest rates would fall at some point in that period.
Yeah,
and
so
at the moment,
and I haven't looked at the yield curve, so I could be wrong, but the yield curve is probably flat. In terms of what I can get for 1 year, what I can get for 5 years. So if that's the case, there's a fear from borrowers that interest rates are going to keep going up for next year, a year after, and rates will go into the teens. Well, the yield curve's not saying that. The yield curve is basically saying that interest rate increases are pretty well done, and I think we're making some calls about we won't see too many more interest rate increases, and that comes from our understanding of the yield curve. It's quite a simple concept. It's a really powerful tool you can use if you're an investor or if you're one of our clients. We're happy to share some charts and some thinking around yield curve.
And it's the input into every asset class, every income producing asset, and every property or whatever other thing you're buying. Because if you think about it, if you bought a commercial property last year that was yielding 4%, or 2 years ago that it gave you an income of 4%, you can now buy a term deposit giving you 4%, maybe over a shorter period of time. But naturally,
you lock it away for 5%.
Yeah, exactly, at 4%. So you're getting the same return, but there's literally zero risk in that term deposit.
Sure.
Maybe I can't say zero, and there's significant risk in that property.
If it's sovereign risk.
If you were buying that property today, you'd expect a 7% return, which means the value of that property would be worth significantly less than what you bought it for. And we're seeing that in different parts of the market at the moment.
Yeah, and that's a frustration within our office. We talk about, how assets are. Well, it's not a frustration; it's a debate in our office that constantly goes on about how assets are valued and how they should be valued. And we're going to fast forward, but if you look at the performance of listed property trusts last month, I think they were down 17%. Is that right?
7% for March 7%, and 17% over the last 12 months, and that's exactly that.
Correct.
Yeah.
So something that's more listed, like ASX listed property, is indicating that the property prices have fallen. Yep. But if you talk to anyone that's in real estate, especially big commercial syndicates, they're saying, well, there's no relevant sales, my property hasn't fallen. And any type of economic analysis says your property's worth less if its interest rates are worth at 5%, then interest rates at 1%.
Regardless of how much you can increase rent, it's still got to be some sort of fall in valuation.
Sure.
But you look at our office here, and you could have two buildings next to each other that are identical. If one of them's on a listed market, it's worth 15% less than if it was unlisted, held by an industry super fund. And it's kind of that unique or weird circumstance where...
Absolutely. It's the power of interest rates. And we talk about, even though that we don't have a lot of accumulators as clients, we talk about what's the best advice accumulators can get, and advice around interest rates for your mortgage, which are typically for an accumulate, biggest asset is the house. The biggest, the majority of that house or property is owned by debt, but people don't take advice around how they structure that debt, if that's fixed or if that's variable, or so that's there's a real gap, I think, in the advice market, advising on what to do with interest rates and how to protect cash flow. So if you think about an accumulator, not our audience, but cash flow management is really important. Interest rate policy is really important, but when we see a lot of people getting advice, those two things aren't necessarily talked about.
And it hasn't been important for 5 years.
Yeah, well,
because interest rates fell to zero, and it didn't really matter. So, but now it really matters. When you're refinancing a mortgage at 6% or above, then it can be incredibly painful. I think we're about to see that in the next 6 or 9 months.
Yeah. So anything from our portfolio you want to talk about, Drew, over the last month? Things went up, things went down. Obviously, it's probably a more negative month than some. But the Australian market, has probably regained most of what it lost through that month.
Yeah, I think it's in total return, including dividends, is flat for the last 12 months. And we underperformed the rest of the world in March, so down 1% compared to like the Nasdaq and some of the biggest global companies, which were up 2 to 3%.
Yeah. So there was a tech comeback.
Quality. I think everyone talks about quality. It's probably the most overused. We talk about it all the time. No one wants to go out and buy a poor quality business. Everyone that comes in to meet us says quality, quality, quality.
Sure.
But what we saw as true quality, the FANGs, so probably less so Facebook anymore, but the Microsofts, the Apples, the massive global tech giants of the world are up 38% so far this year.
Sure.
Just in 3 months.
Yeah, I like the quality, right? So if you think about the tech industry, everyone was brushed with tech, and everyone got this incredible increase in valuation.
Yeah.
But out of that, there'll be the guys that thrive, and that they're the quality groups, right?
And they're just doubling down, like Microsoft buying or investing into ChatGPT and almost transforming their business and becoming a real competitor to Alphabet overnight. But that's,
sure.
Yeah.
I mean, we've obviously been a fan of Microsoft for a long time, and what surprises me is the speed to market. So ChatGPT was launched probably the first week of December, I think. We know the success that ChatGPT has had, but within 35, 40 days of that, Microsoft had invested strategically. I think they spent, was it $30 million to buy a lion's share of ChatGPT, and now we're seeing... Billion. Not million. It's just a B instead of M. Billion. So a big capital investment, not for them, but then they've been able to integrate that into their business really, really quickly. So I think Microsoft's Sidecar is released for purchase by all their consumers in April. So if you think about that, launched, acquired, integrated, all within 6 months. It just shows you what tech could do. If you were 20 years ago trying to integrate 2 industrial businesses, it would take 5 years to integrate them. So.
This is why a lot of people or a lot of headlines talk about the lack of productivity growth or productivity improvement, but this changes the game for our businesses. The ability to not outsource but start and augment the work of employees or parts of the team that are doing even the initial drafting of emails, anything to do with language and words, and it can just make people more efficient and help them focus their roles in the more valuable and rewarding parts of what they do.
Yeah, maybe we're really excited about ChatGPT, but it's going to affect most businesses that we invest into, and it's going to affect our business. There's historically been a lot of arbitrage in terms of pushing employees offshore. So, we've seen a lot of employees sitting in, for all the companies that are in Australia, from India to the Philippines, it's become a lot more accessible to small business, especially the Philippines. But really, that's just an arbitrage on kind of economic conditions, and conditions will change over time. What's really exciting is this arbitrage to AI and technology. So can you get activities done by AI? And I think it will change productivity quite substantially. So
I was talking to someone yesterday and said essentially you want ChatGPT open on your Chrome or on your browser rather than Google.
Yep. Remember, this is I know it's called ChatGPT 4, but this is the first version.
One,
right?
yeah.
So the second version, the third version, the fourth version will just change everything. So.
And the other 2 portfolio comments would be gold bullion.
Yep.
And Asia. I think gold we've used gold as a hedge.
Sure.
Everyone thought initially inflation, but it was very much around hedging against periods of volatility and uncertainty. So gold hit, I think, an all-time high of $2,000 per ounce, but that's $3,000 in Australian.
That's right.
So it's done an incredible role as a hedge, and something we're looking at whether we rebalance or not necessarily exit completely at the moment.
The hardest investment that we've sold to investors over the last 10 years.
It's gold.
Doesn't
provide an income.
I mean, clients, it's not a whinge fest on clients, but clients would always call up and go, I don't understand gold. Why are we holding gold? Well, it doesn't perform, it doesn't provide an income stream. But, hedges are there for a reason, and this is a perfect indication of what gold can do within a portfolio. And
we've talking about our golden rules. One of the big things where we think when you're investing money for retirement is having a portfolio built from multiple outcomes. So gold is one outcome.
Sure.
Holding commodity shares or holding bank shares is another outcome. Yep. So it's always having different parts of the portfolio working differently in different periods of time and in different circumstances.
You mentioned golden rules. What are they?
I was going to go through the 10 of those at the end. There's quite a few.
All right, let's save that for the end. So.
We could sneak them through. And the other one was Asia. So we've had a tactical weighting to Asia. Just the idea that if you look forward 10 years from now, it's pretty obvious that the majority of global economic growth is going to come from the Asian region, whether that's China, Indonesia, population growth, India as well.
India, yep.
Yeah, the population growth's massive. The economies continue to evolve, maybe not as linearly as people expected 2 or 3 years ago, but we had a reopening, end of COVID lockdowns, and you're starting to see not the same bubble of activity that happened in the developed world, but definitely a resumption of some level of growth, and that's spurred the commodity sector.
I think that people get confused about China and Asia. So as soon as you say Asia, they think about China.
Yeah.
China is nearly a first world country versus an emerging country. Very important to have exposure to China, especially same as exposure to the rest of the Asian countries, and they have tailwinds. You think about the population growth, you think the age of the population, you think about adaptation of ideas. They adapt ideas really, really quickly. Yeah. So fundamentally, Wattle Partners has a view to outperform, to grow portfolios. There's 2 simple things you would do in any global portfolio, and that would have a cap bias. So we like mid to small caps as a bias. We still hold our mega caps and our large caps, but these growing companies. And then regionally, we like Asia. Now, probably a bit more volatile, but that's okay. If you're striving for growth over 7 to 10 years, you've got to accept volatility in that. But everything looks like there's a tailwind that sits into Asia.
And it's a complete counter to the rest of the world. So where every other central bank or every other developed country is increasing interest rates, Asia is in a position where they may be cutting interest rates and have limited inflation problems. So you're getting that counterbalance and real diversification.
Yep. All right, so what are we doing in portfolios this quarter?
Working diligently on our quarterly reviews at the moment. We haven't recommended any major changes to strategic asset allocation.
Yep.
Essentially, markets and the different asset classes, whether that's shares or bonds, are moving quite a lot. And bonds are probably more interesting than shares lately. They're moving a lot more quickly. So again, it's all about rebalancing back to those strategic asset allocation weightings.
Sure.
And I think one of the topics we had in here is what does rebalancing mean and why is it important?
Yep.
And I'll pass that one to you.
Yeah, rebalancing is a great way to structure portfolios and get value out of portfolios because it takes some of the emotions out. It's simply rebalancing is if we had 30% in Aussie shares and 30% in fixed income and shares ran for 12 months, what we want to do is sell high and buy low. So essentially what we would be doing is selling a portion of our Australian equities off and we would rebalance that into fixed income.
Yeah,
and this comes through kind of efficient portfolio, originally kind of designed by Markowitz many years ago. But balancing is so important, but so hard to do, because emotionally, what it does is allow you to give you a framework to sell things that are emotionally really positive. So you're selling your winners, and essentially what you're doing is buying losers. So if we said to everyone, we did this last quarter, if we said, hey, global tech or global funds have had a bad time in the last 12 months. They're down 25%. You should put more money in it. The reaction of most people emotionally is, no way, I'm not going to do that. But if you can provide a framework where you take from and say, well, no, strategically we said we would have 20% in global shares and it reduces to 16 and you can buy another 4% at a discount, then that provides this great framework for you to manage your portfolio and avoid, trends and emotional biases that you have in portfolios, and say, well, this is our blueprint to manage money, and always come back to the blueprint. It also helps when markets correct substantially or crash, and then if you can rebalance then, when you can sell, you've got a framework to be able to emotionally get past selling some losers, or selling some winners to buy losers, the ramifications of long-term returns is substantial. So
that's so important because the sentiment or the cycle in markets turns incredibly quickly. So if it was commodities that worked last year or if it was Australian shares that worked last year, there's no guarantee that they work again this year. So not doing that rebalancing means you're saying that you expect a continuation of what happened.
Sure.
So it's almost counterintuitive and removing emotion from investment decision making.
Yeah, absolutely. And some of the pitfalls. So we always say that the fund that is getting the most inflows, we avoid.
Yeah.
And if you look at history, that's probably been a pretty good indicator. And what I'm seeing anyway when I'm seeing new clients is a lot of clients have been trapped by, not trapped, but they've over allocated to ETFs and passive. There's been a big push, through COVID about being passive in ETFs, and everyone thinks that's fantastic when you're getting plus 10 or 12% per annum. But when you're in ETFs and you're in an Asian ETF and it's fallen 48%, it's hard to be conviction.
Yeah.
So, this balance of portfolios, as you mentioned before, is really, really important. So an active super fund last year versus a passive super fund, there was probably 6 or 7% difference. So, it's really important to remember who's influencing your decisions and why, and there's a bigger market out there.
And how they're working together, definitely. And we can feed that into our golden rules if we want to get through all 10. Yeah, maybe start with 5.
Who we saw, but we've kind of covered this. Nick Griffin from Munro is talking about AI. We'll do a session with him. Yep. Really impactful. There's a thought leader called Michael Colo that we caught up with around ChatGPT and how it can become efficient, and we'll probably do some work with him as well. And then let's finish off on is it 10, Drew? The top 10.
It is 10. I kept it to 10.
Top 10 golden rules. So
I think it's, and as people have met us and seen us evolve over time. These will always evolve, and they're rules that work that have been built over a long period of time. But they're also relevant to the fact that we very much specialise in retirement and investing a finite pool of capital, and the unique requirements that you need to apply to make sure that lasts as long as possible, and increase the probability that your money outlasts you, not you outlasting your money.
Sure. I mean, this podcast could go on for hours if we cover all 10, but let me read them out and then maybe we'll pick one or two.
Yep, go for it.
So, first number rule, which we just talked about, asset allocation is paramount. Number 2 is beta is free. 3 is smoothing the ride. 4, be agnostic to product. Number 5, income plus growth equals total return. Number 6, define the game you are playing. Number 7, things will go wrong, as they do. Number 8, don't bet the house on your base case. That's a good one. Number 9, alternative assets, just straight alternative assets. And number 10 is rebalancing and tactical allocations. So let's pick a couple and go through. Do you have a preference, the ones you want to talk about?
I mean, we've definitely covered rebalancing and asset allocation in this kind of discussion already, and probably beta in recent weeks too.
Yeah, okay. What about define the game you were playing?
I think this is the biggest one, and this is where we talked about rebalancing, but the emotional impact of investing.
Sure.
We've found the only way you can get people to make sound, kind of informed, less and remove emotion from investment decisions is to keep reiterating what the purpose of their investing is.
Sure.
It's so easy to get caught up in what stock's done well this year, lithium, energy last year, whatever it happens to be, or what fund's done incredibly well, which funds have done bad, and buying and selling on that basis. Define the game you're playing is just meaning every initial conversation we have with a client, every ongoing conversation is, what do you want from your portfolio? For most people, it's a certain amount of income. So if it's a certain amount of income, that's what you should measure your decisions on and your ongoing performance on. And this kind of gets rid of the old saying of the Joneses keeping up with the Joneses. Yep. So who cares what your mate's saying at a barbecue if you're generating the income you need, whether it's $100 or whatever, $100,000 in retirement tax free.
Sure.
If you're achieving that goal, the rest of it is irrelevant.
Things will go wrong. Most people freeze when that happens. So they freeze, maybe sack their advisor, blame their spouse, have a cry.
And this is on a stock and a market level. So the market can fall 30%. You're investing into companies that change and they're exposed to the economy. So things will go wrong is the idea that even you
can't just all pick winners. You can't.
Yeah, you can. We judge ourselves on the losers.
Sure.
But even the most successful investors get it wrong 40% of the time. So the top hedge fund managers, the top stock pickers will always get 40% wrong. It's whether you can reduce those or reduce the impact, it's actually more about the fact that even if things go wrong, you can still generate strong 8 to 10% compounding returns over the long term. History's shown it consistently. Companies go bankrupt within major benchmarks.
Absolutely.
Things will always go wrong, but as long as you're limiting how many go wrong, and it's not 100%, then you'll still be able to get the benefits of compounding and generating that consistent income over a long period of time.
Sure, it's very similar to what our old boss used to say, Ian Murdoch. He had a saying which was pat the dog. So essentially some investments that have gone negative, as you would, is pat the dog, keep him happy, keep it within your portfolio. So you don't want to always just sack your losers and get rid of them because they'll put in a portfolio for a reason. Probably gold is a good example where we mentioned gold was a really hard investment to keep in clients' portfolios because at some point when markets did really well, it didn't perform because it's a hedge, right? So
definitely
just understand what you're doing. And one we've been talking about is really simple, and I'm sure most people think we're crazy, but this income plus growth equals total return. That's around focus, isn't it?
Yeah, definitely. And I think a lot of the time when we meet people, we probably had questions this week as well, that it was very much all people initially look at is the headline income they can get from if they're DOI from the stock, from the share they're buying, from the fund they're buying, from the ETF they're buying. But we've shown history data that relying on high headline dividends, or if you're investing into companies that are paying out most of their profits as a dividend they're not investing in themselves and ultimately end up destroying capital.
Sure.
And it's time and time again you see it. So what we are looking for is the ability to generate a consistent income today, but one that's going to grow over time because the re-emergence of inflation has increased the importance of not only growing your capital but actually making sure your income's increasing each year. And not stagnating.
Because you've got a finite amount of capital, but you don't know how many years that's going to last, right? And,
exactly.
A retiree now, I think the stat says if you're married and you're 65, one of you will live to 94.
Yeah.
So you're talking about, and probably by the time you get there, if you live to 90, you're probably going to live to 105. So income plus growth, the problem that you were talking about is if you have a bias to income within this strategic asset allocation, that you're manipulating the concept of strategic asset allocation.
Yeah.
So one of the things that people do need to note is if strategic asset allocation drives 90% of all returns and then you've got a biased income, you're essentially changing your strategic asset allocation. So you're reducing the chances of achieving what is achievable by investing prudently, which might be acceptable by some. The way I like to think about it is if you play with the most appropriate allocation to income and growth as a portfolio and you preference income over growth, you're probably going to have an effect in total return. Which might be acceptable for some, right? Some people want a stronger income, but you can't expect the growth to be the same. You can't dial up income without having an effect on growth.
Exactly.
Any other? Free choice for Drew out of your 10.
Always, we talk about a lot, which is be agnostic to product. And this is the idea in the news or in the paper. It always comes out as value versus growth, or active versus passive. Active being, or passive being index investing.
Sure.
Our view is that when we sit down as an investment committee and we find an allocation or an asset class we want to be exposed to, it could be Australian shares. The first thing we think about is what's the lowest cost way to do it, but is that efficient and is that the exposure we want? So all of our portfolios will always blend ETFs and managed funds and potentially stocks depending on the person, but they'll also blend active management, passive management and value versus as well as growth investing. I think that's the whole key to having resilient portfolios that are able to continually generate returns regardless of the economic or market environment behind them.
That's right. So the starting spot is every product or investment that's available. And then think about the value prop of each one and then keep coming down. Too many investors, too many advisors limit themselves about, what's on a platform, or I only use ETFs, or I like low cost over high cost, and they essentially have biases. The best way to manage money is to go, what are the risk and return characteristics of the whole universe? What can I get access to? What makes sense?
Yeah, exactly.
Great. Thanks, Drew. So these will be on our website and built, and it's a living document, so it'll be constantly changed. I have seen some clients have their own rules, and a lot of times those clients would bring their rules in. So as you are transitioning through retirement, it's really important to know what you stand by yourself. We have our own rules, but what does the client, especially when you're a couple, important that they kind of agree on what they do and when they do it. Some things like this about we will always rebalance is really important, from maybe a wife that's not engaged as much. So rebalancing is important. So these kind of rule concept works really well in terms of managing money, not just for us, but also our clients.
Yeah, definitely.
Any words you want to finish on? Something we haven't covered, Drew, that you want to mention?
I think we'll probably put in the links to the video, the podcast that we're on regularly. The Australian Investors podcast.
Did we talk about that last week? That you're now a celebrity? So
Hopefully
Drew appeared in Australian Ethical Video, and I had you and your son.
Almost had the dog. The dog ran off though.
Have we put that on our website yet, or have we sent it out?
I don't think we've shared it, so we'll include it in the links to this as well. So essentially, we were interviewed to try and help educate the rest of the financial advice industry on how we're applying more responsible and sustainable investment approaches to our client portfolios.
Sure.
And how we've evolved on that over the years. And as most people know, we're a B corporation, recently got recertified for that too. So sustainability and responsible investing is pretty central to the way we manage money.
Absolutely. And remember, our foundations come from Austin Donnelly that established this business in 1971, started the Investing Times, and was an advocate for investor rights and education. And very much Drew and I have been, we live and breathe that. And that's why you'll see not just these podcasts for our clients, but a whole heap of different things. You are a co-host in, I think it's Australia's most popular podcast in financial services at the moment, so with Owen Raskovich, so you appear there every other week. We do some stuff with Self Wealth and help them educate their audience. Drew and I are now in the middle of writing a book around retirement, so should be out by the end of the year. It started well. So, all our knowledge about retirement, all the financial ins and outs, and all the non-financial stuff will be in a book that's released later in the year. So it's a hopefully it helps people, even if they're not our clients, helps people through this kind of last third of their life or golden years of their life. And, you've got golden rules as well. So it all fits well.
So just a final one, Jamie. I believe you received quite a nice gift from a client this week.
Yeah, I think that's the thing that makes us different is essentially we provide financial planning advice, but we build long-term relationships with clients, and they become really close to us and friends. And a big shout out to a client that I've had for the last 20 years, Vina Brailsford. I met her when she first retired. 20 years ago, she worked at the University of South Australia.
She definitely sends us chocolates every year.
Yeah. So this is a gift that she sends on Easter. So she's a lovely client. We've done great things with her portfolio. So maybe I can share an egg.
Oh, it is a chocolate.
Yeah, an egg with you from Vina. And shout out to the clients that essentially give us a lot of love as well. It's not just a purely financial transaction. We know a lot about their lives. They know a lot about ours. As you said, they're more interested in our children than in us. And in a lot of meetings we speak, 40% of the time about a family, and then get on to their life. So really appreciate that to us. That's why we do this job, why we're not sitting in a bank crunching numbers. The client's meant a lot, and Vina's been a wonderful client over that period of time. It's actually an interesting part in my life because I'm 47 and I got some clients when I was in early 20s, so I've seen their whole retirement. Some have passed, but some are still with us. So you kind of, when we write this book about retirement, I've kind of lived it from the first day they've started retirement and the emotional journey and a loss of a partner and into aged care homes. And I think that's really special to spend and share the retirement with clients. I don't like being 47, but it's an interesting reflection on what clients going to retirement have seen over that period. And again, thank you, Vina, for your love over the period. So we'll put some links into other activities that we're in, and if people are interested, hopefully it's of benefit to them. Always open to questions. So this is a new format. We've only been doing, I think this is the third or fourth time. We've had some good feedback. If there's stocks you want us to cover more in depth, if there's investments, email Drew and I, and we'll make sure next month we cover them in this podcast. So thanks, Drew. Been great.
Good to see you.